The headlines say the housing market is cooling. That's the nice way to frame it. But if you're paying attention to what's actually happening in real neighborhoods, in actual towns where millions of Americans live, a different story is emerging, and it's one the mainstream media hasn't caught up with yet. Here's the contradiction nobody wants to talk about. We're being told the market is stabilized, home prices are moderating, things are normalizing. But in 12 specific cities across America, something far more serious is unfolding. People who bought homes at peak prices are watching their investment evaporate. Families who relocated for jobs are trapped in underwater mortgages. Investors who bet on perpetual appreciation are cutting losses, and the rest of the country hasn't realized yet that what happens in these cities spreads outward like domino. The question isn't whether housing will cool, it already is. The real question is whether we're watching a correction or the beginning of something much larger. Over the last 15 years, Americans bought a story. It was a beautiful story. Home ownership was the American dream. Real estate only goes up. If you could afford the down payment, you couldn't afford not to buy. Entire industries, financial services, construction, real estate, lending, built themselves on this assumption. Cities marketed themselves as the next big thing. Tech hubs, emerging metro, the places where your money wouldn't just be safe, it would multiply. And for a while, it worked exactly as advertised. People left expensive coastal cities and flooded into secondary and tertiary markets. Austin, Tampa, Miami, Charlotte, Phoenix, Denver, these cities became magnets for migration. Millennials fleeing high rents, retirees seeking lower costs, remote workers untethered from office locations, investors betting that everyone else would follow. Building cranes dotted skylines, construction jobs appeared, prices climbed, double-digit appreciation became normal. People felt wealthy just from owning property, even if they hadn't paid off the mortgage. Between 2020 and 2022, this dynamic hit warp speed. Pandemic migration, historic low interest rates, limited inventory, stimulus money, the perfect recipe for the most intense real estate rush in modern memory. Homes that sold for $300,000 suddenly went for $500,000. Bidding wars became standard. People bought without inspections. Terms got more and more desperate. Everyone was convinced this was the one time in history when the trend wouldn't reverse. That conviction is still embedded in millions of American minds. And that's precisely the problem. But markets don't move in one direction forever. They move in cycles, and cycles always reverse. The shift started subtle. Rising interest rates through 2022 and 2023. Suddenly, a $400,000 home didn't cost $1,800 a month anymore. It cost $2,800 a month. Affordability evaporated overnight. The pool of buyers shrank. Inventory, which had been scarce, started to pile up. And for the first time since the pandemic began, price momentum stalled. Then came the wake-up call. In certain cities, prices didn't just stall, they fell. Not by a few percentage points, by double digits. And they kept falling. Austin saw prices drop 15% from peak. Tampa and Jacksonville followed suit. Phoenix prices contracted. Miami saw significant declines. Smaller cities in Florida, Texas, Arizona, the very places millions of Americans had rushed to, started showing signs of serious pressure. This is the moment most people miss. They see national headlines that say home prices down 2% and think, okay, a small correction will bounce back. But that national average masks the truth. National averages are heavily weighted by expensive coastal markets where prices are stickier. When you zoom into specific cities, you see a completely different reality. In some places, we're not talking about a correction anymore. We're talking about depreciation. Rapid, sustained, painful depreciation. And here's what makes this particularly dangerous. The people who bought in these cities over the last 4 years are now trapped. They bought near peak prices with high interest rates locked in. They can't sell at a loss if they're planning to stay. The psychological and financial blow is too severe. They can't refinance because rates haven't dropped and their home is worth less than the mortgage. They're locked in, immobilized, and that immobilization has consequences. Let's talk about the cities facing the steepest declines. Start with Tampa. Marketed as the new frontier for remote workers and young families. Prices nearly doubled between 2020 and 2022. Now, homes are down 12 to 15% from peak. Thousands of people who moved there expecting appreciation are sitting in homes worth less than they paid. The psychology shifts. Regret sets in, and regret leads to desperate decisions. Jacksonville saw similar dynamics. A supposed tech and retirement hub. Prices surged. People relocated entire businesses there, and now we're seeing corrections of 10 to 14% in many neighborhoods. That $500,000 home is now worth $430,000. The family that bought it is watching their down payment erode. Phoenix was even more dramatic. Arizona's capital attracted builders, young families, remote workers, and investors. It felt inevitable that prices would climb forever. They climbed to historic highs. Now there's real evidence of cracking. Prices in many areas are down 12 to 16% from peak. New construction that was supposed to sell fast sits unsold. Builders are cutting prices. Investors who snapped up multiple homes are selling at losses just to get liquid. Austin, yet the tech darling, the place where every venture capitalist and software engineer was supposedly headed. Yes, Austin is a real city with real job growth, but it attracted speculators and false narrative. When IT job growth slowed and remote work lost its shine, the rush reversed. Prices have fallen 10 to 15% in many neighborhoods. Miami, the luxury destination, the place where international money and domestic wealth converged. Condos built speculatively, priced speculatively, bought speculatively. Now, many are sitting empty, or worse, underwater. Price declines of 8 to 12% are common in the condo market. Then there are the smaller cities, Boise, Reno, Las Vegas, parts of California, college towns that experienced urban migration, all showing significant price deterioration. Some are down 15–20% from peak. But here's what makes this systemic. These aren't isolated markets. These are the cities where millions of Americans moved in the last 5 years. This is where new mortgages were written. This is where wealth was supposed to be building. And this is where it's being destroyed. Why is this happening? What changed? The mechanics are straightforward. Interest rates rising from 2% to 7% fundamentally changed affordability. A $500,000 home at 2% interest is affordable on a normal middle-class income. At 7%, it's not. The market adjusted by pricing people out. Supply, which was artificially constrained, began to loosen. New construction continued, even as demand cooled. Migration reversed in some places, and with less demand chasing inventory, prices fall. But there's something deeper happening too. Remote work, which was supposed to be permanent, proved temporary for many people. Companies called people back to offices. The flexibility that justified moving to Tampa or Austin or Phoenix disappeared. Suddenly, you're in a lower-cost city without the job flexibility that made that trade-off rational. You're trapped. Pandemic stimulus wore off. The extra money families had saved is gone. Credit card debt is at all-time highs. Student loan payments restarted. The financial cushion that enabled people to buy homes stretches even further has evaporated. Financial stress increases. And when financial stress is high, something has to give. Often, it's the mortgage. Interest rates staying high longer than expected means that refinancing, which many people plan to do, isn't an escape route. You're stuck with a high-rate mortgage on a depreciated home. That's a painful combination. And here's the psychological factor that's rarely discussed: investor exodus. When speculators and institutional investors realize appreciation is gone, they sell aggressively. They're not holding for the long term. They're not emotional about their investment. They cut losses and move capital elsewhere. And when investors flood the market with supply, prices fall faster. It becomes a cascade. So what does this mean for actual people? Let's talk about Robert and Jennifer. They're both 42, solid middle-class jobs. In 2021, they sold a condo in Chicago and moved to Tampa for a job opportunity and a lower cost of living. They bought a $450,000 home with a 3% interest rate, down 20%. They felt like they'd made the smart move. 2 years later, their home is worth $385,000. That $90,000 down payment? It's now worth $40,000 in real equity. Half their savings is gone, just sitting in a depreciating asset. Jennifer's job situation changed. Robert's about to lose his position due to restructuring. They're considering selling, but selling means taking a $30,000 loss. They stay put, hoping prices recover. Hope isn't a strategy. This is their situation, and it's happening to thousands of families right now. Then there's Marcus, a 38-year-old investor who bought 3 single-family homes in Phoenix between 2020 and 2022. He spent $1.2 million on these properties, thinking rental income plus appreciation would build real wealth. Rental income is good, but appreciation became depreciation. His 3 homes are now worth roughly $1 million total, and he's underwater on the portfolio. Refinancing isn't an option. He's considering a sale, which would lock in losses. Instead, he's holding, hoping, and stressed, constantly stressed. Or take Sarah, a 56-year-old who retired early and moved to Miami in 2021, bought a condo at $350,000. She planned to build a nice life there, maybe sell in a few years for a profit and move somewhere else. That's not happening. The condo is worth $300,000. Her retirement timeline is dependent on real estate appreciation that's no longer materializing. She's reconsidering her retirement date, working a few more years. The dignity of retirement deferred because of a real estate miscalculation. These aren't edge cases. These are thousands of people with similar stories, all concentrated in the same dozen cities, now all facing the same financial reality simultaneously. But the impact extends far beyond individual families. family. When home equity evaporates, consumer spending changes. Home equity was a major psychological wealth source. People felt rich because their homes were worth more. That feeling funded spending, confidence, consumption. When that feeling reverses, behavior reverses. People cut back. They're more cautious. Retail spending slows. Service economies struggle. Construction halts. In cities that experienced explosive growth, construction jobs boom when prices are rising. Contractors, framers, electricians, plumbers, inspectors, entire sectors exist in boom mode. When that boom stops, those jobs disappear. Workers leave, or they stay and underemploy. Services that depend on construction spending, local restaurants, supply stores, labor agencies, feel pressure. Then there's the cascade effect on building supply. Speculatively built new construction was supposed to sell. Now it doesn't. Developers cut prices. Existing homeowners see their homes depreciated by new construction cheaper than theirs. They cut prices too. The race to the bottom accelerates. Tax bases take hits. Lower home values mean lower property tax revenue for cities already strapped. Schools, infrastructure, public services suffer. It becomes a feedback loop of decline. Mortgage delinquency rates historically spike when home values fall below mortgage balances and interest rates are high. We're setting up the conditions for that to happen. It hasn't materialized in these markets yet because employment is still reasonably strong in most places. But we're in the early innings. This is the first or second inning of what could be a longer game. Now here's where most analysis stops, and it's exactly where you need to think deeper. This situation is not uniform across all of America. High-cost coastal markets, New York, San Francisco, Boston, Los Angeles, they're holding up better. Why? Because prices are so astronomically high that even with depreciation, they're less affordable than they've ever been. Supply is genuinely limited. Jobs in these markets actually justify the prices. The wealth concentration is real. Institutional investors still find value there. Meanwhile, these secondary markets that exploded in the last 5 years, they're vulnerable because the appreciation was speculative, not fundamental. The job growth narrative was oversold. The cost of living advantage is less real than advertised when you factor in lower salaries in many of these cities. The migration narrative was oversold, and when oversold narratives meet reality, pain follows. But here's the surprising part. There's a level where this stabilizes, not where prices reverse upward dramatically, but where they stabilize. It happens when prices fall enough that affordability returns, when the migration narrative exhausts itself, and when investors reset expectations. The question is, how much further down do they fall before that stabilization happens? In some of these cities, we might be 50% of the way through. In others, we could be in the first quarter. That variance matters enormously for people holding assets in these places. There's also something counterintuitive worth understanding. Recessions don't necessarily cause housing collapses in every market. They do in places where speculation was extreme and fundamentals were weak. But in places with strong employment, reasonable fundamentals, and less speculative buying, housing can actually hold up during recessions. The real danger in these 12 cities isn't recession per se. It's the specific dynamic of massive speculative inflows followed by the reversal of that flow. That's a special kind of painful. And it's exactly what's happening. So what should you actually do with this information? First, if you own in one of these cities and you're considering selling, understand that the window where you can sell for less damage is closing. But holding forever, hoping prices recover, isn't a strategy unless you're in it for 30 years and you believe in the fundamental growth of that city. If you need liquidity in the next 5 to 10 years, timing the exit matters. Second, if you're considering buying in these cities, wait. Or buy when you see the stabilization signal. When prices stop falling, when inventory starts to tighten again, when job growth re-accelerates. Don't buy falling knives. That's not investing. That's catching depression-era prices in hopes of a recovery you can't guarantee. Third, if you're in a high-cost market watching this happen elsewhere and feeling grateful you didn't jump into the secondary market gold rush, recognize that your market might be more insulated, but it's not immune. These patterns eventually ripple outward. Not immediately, but they do. Fourth, if you're thinking about relocating, decouple the housing decision from the migration impulse. Don't move because everyone else is moving. Move because the economics make sense for your life, for your job, for your family situation. And when you move, be honest about whether you're buying a home or buying into a narrative. The bigger implication is this. For the last 15 years, Americans have been conditioned to believe that housing only goes up, not just normally, inexorably. That narrative is broken, and breaking a long-held narrative always damages people who organize their lives around it. Some of the damage has already happened. Millions of people made decisions based on a false premise. They've already paid the price and lost equity, trapped mortgages, and regret. but the full impact hasn't materialized yet. Delinquencies haven't spiked. Foreclosures haven't accelerated. The psychological and financial devastation of widespread negative equity hasn't fully hit. We're in the window where policymakers, builders, and homeowners are still operating as if this is a temporary dip. They're not yet reorganized around the reality that some of these markets won't return to peak prices in any reasonable time frame. When that reorganization happens, it will reshape everything. Construction projects halt. Entire neighborhoods stall mid-development. Migration patterns reverse. People who move to these cities start moving back or elsewhere. Tax bases contract. Services decline. The economic momentum that defined these cities for 5 years vanishes. This isn't apocalyptic. Cities and markets are resilient. New fundamentals establish themselves. But the transition is brutal for the people caught in the middle. The deepest insight here isn't about any individual city. It's about the danger of consensus narrative. When everyone agrees on something, housing always goes up. This city is the future. Remote work is permanent. Prices can't fall. That's exactly when you should be skeptical. Consensus is comfortable. Consensus is reassuring. Consensus is wrong more often than it's right about the future because it's built on recent experience, not on fundamental analysis. The investors who saw the housing crash coming in 2007 weren't ignoring data. They were questioning the consensus. The people who moved to Tampa in 2023 weren't being foolish. They were following a narrative that had been validated for 3 straight years. But 3 years of upward movement isn't fundamental validation. It's momentum. And when momentum reverses, the people caught in it are the ones who lose. We're living through a specific moment right now. Not a crisis, not a crash, but a reset. A fundamental repricing of where people should live, what homes should cost, and what the relationship between migration and real estate should look like. In 12 cities across America, that reset is happening now. Homes are falling in value. Families are trapped. Regret is settling in. And nobody wants to talk about it because it contradicts everything we've been told for years. But silence doesn't change reality. Reality changes regardless of how much we talk about it. The only question is whether you see it coming, and whether you adjust accordingly. The housing collapse isn't coming. It's already here. It's just not evenly distributed yet. And if you're in the wrong place at the wrong time, understanding that distinction might be the difference between moving strategically and being forced to move desperately.